Welcome to Audiobooks Home, your destination for powerful ideas made simple. Today, we are diving into one of the most influential investment books ever written, The Intelligent Investor by Benjamin Graham. This book isn't about quick tricks or shortcuts. Instead, it teaches timeless principles of investing, how to think long-term, avoid costly mistakes, and build true wealth with patience and discipline. Warren Buffett himself, one of the richest investors in history, called it by far the best book about investing ever written. In this summary, we're not just scratching the surface. We'll explore 5 key chapters that carry the essence of Graham's wisdom. The difference between the intelligent investor and the speculator. The defensive investor versus the enterprising investor. The concept of margin of safety. Understanding market fluctuations. The story of Mr. Market. Building a sound investment strategy for the future. By the end of this audiobook-style summary, you'll walk away with practical insights you can apply in your own financial life, whether you're just starting your investment journey or already building your portfolio. So, sit back, relax, and let's begin. Open Book Chapter 1. The difference between the intelligent investor and the speculator. Benjamin Graham begins by drawing a sharp line between 2 types of people in the market: investors and speculators. An investor is someone who buys stocks as if they are buying a piece of a real business. They think long-term, look at fundamentals, and care about value. A speculator, on the other hand, is someone who tries to make money from short-term price movements, guessing where the market will go tomorrow or next week. Here's an example. Imagine you buy shares of a company because you believe in its product, management, and long-term growth. That's investing. But if you buy just because you think the stock will go up 10% in the next 2 days, that's speculation. The danger of speculation is that it often feels exciting. People love the adrenaline of quick profits. But Graham warns, treating speculation as investing is the fastest way to lose money. Key takeaway: the intelligent investor focuses on safety, growth, and long-term results. The speculator chases short-term gains and often ends up disappointed. Open Book Chapter 2. The defensive investor versus the enterprising investor. Graham knew that not all investors are the same. Some prefer to play it safe, while others want to put in extra effort for potentially higher returns. That's why he divides investors into 2 categories. The defensive investor prioritizes safety and simplicity. Doesn't want to spend too much time analyzing. Should stick to a balanced portfolio, like bonds and index funds or high-quality, dividend-paying stocks. The enterprising investor, willing to put in time and effort studying businesses, ready to dig into financial statements, industry analysis, and valuation. Looks for undervalued stocks that the market is ignoring. Think of it like this. A defensive investor is like someone who prefers to walk on a safe, well-lit path. An enterprising investor is like an explorer searching for hidden treasure, but with preparation and skill. Both approaches can work as long as you stick to discipline. The mistake comes when defensive investors try to act enterprising without the skills, or when enterprising investors act recklessly without research. Key takeaway: choose your investor type honestly. Are you defensive or enterprising? Build your strategy accordingly and stay consistent. Open Book Chapter 3. The concept of margin of safety. If there is one principle that defines Graham's philosophy, it's the margin of safety. Think of it like this. If a bridge is built to carry 10,000 pounds, engineers won't load it with exactly 10,000 pounds. They'll allow for a margin, maybe 7,000 pounds, to ensure safety even in unexpected conditions. Investing works the same way. When you buy a stock, you don't want to pay the full price of what you think it's worth. Instead, you buy it at a discount, leaving a margin of safety. That way, even if things don't go perfectly, you're still protected. For example, if you believe a company's stock is worth $100 per share based on its earnings and assets, an intelligent investor might only buy if the price drops to $70 or $80. That cushion protects you from mistakes, downturns, or surprises. Margin of safety isn't just about price. It's also about being conservative in your expectations. Don't assume everything will go right. Plan for setbacks. Key takeaway: always invest with a margin of safety. It's the golden rule that shields you from losses and maximizes long-term success. Open Book Chapter 4. Understanding Market Fluctuations, the Story of Mr. Market. Perhaps Graham's most famous lesson is the parable of Mr. Market. Imagine you have a business partner named Mr. Market. Every day, he comes to your door and offers to either buy your share of the business or sell you more. Some days he's optimistic, offering high prices. Other days he's pessimistic, offering very low prices. The trick is, you don't have to listen to him every day. You can ignore him when his prices are unreasonable and only act when it benefits you. This story teaches us about market psychology. The stock market is full of ups and downs driven by emotions like fear and greed. Intelligent investors don't react emotionally. Instead, they see volatility as an opportunity. For example, during a market crash, speculators panic and sell everything. But the intelligent investor calmly sees it as a chance to buy quality businesses at a discount. Key takeaway: don't let market emotions control you. Use Mr. Market's mood swings to your advantage, buying when prices are low and resisting the urge to chase overpriced stocks. Open Book Chapter 5. Building a Sound Investment Strategy for the Future. Finally, Graham ties everything together by showing how to build a strategy that lasts for decades. Here are his timeless principles. Diversify wisely. Don't put all your money in one stock. Spread it across different industries and asset classes. Balance risk and return. Keep a mix of safer investments like bonds and riskier assets like stocks. Be patient. Wealth builds slowly. Compounding works best over time. Stay disciplined. Stick to your plan, no matter what the market is doing. The intelligent investor doesn't try to beat the market every day. Instead, they aim to build consistent, reliable wealth that grows steadily over the years. As Graham reminds us, the essence of investment management is the management of risks, not the management of returns. Key takeaway: a sound strategy is built on discipline, patience, and risk management. Think decades, not days. And there you have it, the 5 core lessons from the intelligent investor. Separate investing from speculation. Choose your approach, defensive or enterprising. Always invest with a margin of safety. Learn from Mr. Market, but don't follow his emotions. Build a disciplined, long-term strategy. The beauty of Graham's wisdom is that it doesn't depend on trends, fads, or predictions. It's timeless. If you follow these principles, you won't just survive the market, you'll thrive in it. Thank you for listening to Audiobooks Home, your destination for powerful ideas made simple. If you enjoyed this summary, don't forget to like, subscribe, and share it with others who want to master the art of intelligent investing. Until next time, invest wisely, stay patient, and trust the process.